listening to me, you have decided to continue in accounting, and I'm glad that you are here. Today I'm going to talk about Chapter 3, which is Accrual Accounting and Income. This chapter really, in my personal opinion, should be the first chapter, but they decided to put this one in Chapter 3. The reason why I think it should be Chapter 1 is because it frames everything, in my opinion, that you'll be doing in accounting. It frames the why of it and, in many cases, the how of it. But here we are, Accrual Accounting and Income. So we're going to explain accrual accounting, first of all, what it is. And we're going to explain how is it different from cash basis accounting. What is cash basis accounting? We're going to talk about the recognition rules that relates to expense and revenue. We're going to learn how to adjust accounts, and we're going to construct financial statements. We're going to close the books. What does that mean, closing the books, and how we do that? And then we're going to talk about some ratios, and that's basically how you analyze an organization. In this case, we're going to talk about debt paying ability, so ratios that relates to debt. So, first of all, what is accrual-based accounting? I don't know why we would talk about what's different from it, but I really want to get into what it is, and just kind of help you understand generally accepted accounting principles and why things are recorded the way they're recorded. GAAP, which is in the United States, is our procedure, our set of rules and concepts that guide how we record transactions, how we report these transactions, and really what we're trying to do. What we're trying to do is measure financial information in a uniform way so that you can compare one organization to another, and they don't have to be in the same industry. We want to have uniform consistency, we want to have uniformity, we want to have relevance, and we want to have the matching principle. We want to be able to match our expenses with our revenues when they have been incurred. So when we talk about accrual accounting, we're talking about the recognition of revenues and expenses. We want to talk about how we show information and why it's recorded and when it's recorded. So accrual accounting is going to differ, and I believe in many ways due to timing. So we're talking about how these transactions are going to impact our financial statements when they occur. What is the timing of that recording of that information? So recognition, in my personal opinion, is the reality that this transaction needs to be recorded. So when you're talking about recognition, we're saying, do we record it? And the answer is, depending on the rule we're trying to apply. In the case of revenue, did we earn the money? Yes, we earned the money, so we are going to recognize or record. But it's also required because we want to recognize when we earn the revenue. And we do not really necessarily care when the cash is received. For purposes of determining if we are to record a transaction, in this case revenue, we want to know if it has been earned. Has the earning process been completed? Did you do everything that's required of that particular job? Have you completed the job? Have you completed the work? And the answer is no, you do not record it. If the answer is yes, you do record it. When expenses are incurred, that word incurred is so vague. I would like to use the word used. When you have made use of something, you've incurred an expense. If you used an asset, you've incurred the expense associated with it, whether it be supplies or whether it be a long-lived asset, depreciation. If you've used it, you've incurred the expense. So when we say expenses are recorded when incurred, expenses are recorded when used is the best way to interpret that. So what makes it different from cash basis is we're going to record revenue when cash is actually received. When that person writes a check to you and hands it to you, that's when you record the transaction. That's cash basis. When you actually pay that particular bill, in the case of telephone bill or employees or whatever you're paying, when you pay it out, that's when you record it. That's the cash basis of transactions. And we don't want to record transactions in that way because it does ignore a lot of important information. In many ways, it could understate your revenue, and it can most certainly overstate your expenses because, if you buy an asset and your asset is going to be used over 5 years and you record it as a cash-based transaction, meaning you record the expense or the use of that asset the moment you buy it, that's not going to really accurately reflect the use of that asset, particularly when it's used over multiple periods of time. So it can very well give you incomplete results in terms of your financial and very misleading information. So for external purposes, for purposes of providing information to external users, financial accounting in essence, we are going to be using the accrual basis of accounting. So how is it different? We are going to show when we record transactions when we have earned it. So collecting cash from customers is not going to be when we record our transactions for cash. We're going to record our transactions when we earn. We're going to record our revenue when we earn it, when we earn the money. So cash-based transactions, you basically record it when you receive cash, or when you pay for something, or when you borrow money and you receive that, when you pay off loan, or when you issue stock. Again, these transactions are not wrong. It's just that they have to be recorded differently if we're going to be using the accrual basis of accounting. So when we talk about accrual basis of accounting, we're definitely dealing with a time period concept. We're going to be talking about reporting our financial information over intervals, over time. We're going to be talking about an accounting period which includes 12 consecutive months, and generally it's going to be a year. Okay, now we're not talking about fiscal periods. A fiscal period could be 12 consecutive months from January to December, or it could be a fiscal period meaning June or July to June. In the end, 12 consecutive months comprise of the basic accounting period. Whether it be a fiscal year, whether it be a calendar year, does not matter. Now, sometimes organizations, particularly public organizations, they may have to prepare quarterly financial statements and report that information. And that's an interim period. It is not a full 12 months, but it may very well be 3 months or 6 months or 9 months. So apply the revenue and expense recognition principles. Okay, how do we do that? We have to deal when we record transactions. So when you see recognition, you're going to automatically say it's recording. So when do we record it? Revenue is recorded when the business have promised something to a customer and they completed that task. They have actually done what they have said they were going to do. So if we have an example, I am going to work with a client, and my job is to provide them with audited financial statements, and I do the work. I need to recognize the revenue because I've earned it. They may take 45 days to pay me in cash for that service, but for recognition rule, the revenue recognition principle requires us to record the revenue when we have earned it. But there's also another issue. You have to have an amount. You have to be able to quantify that amount. And that's what amount of revenue to record. We want to record the fair market value of that service, or the consideration. In this case, we have a contract between the two of us for $50,000 for me to provide that service. I provided that service, and I'm going to recognize the revenue. Now, you and I may have an agreement to say, I will pay you for this audit engagement 60 days after completion of that service. And if you both agree to that, so be it. But in the end, on my books, as I'm providing a service, I'm going to have to recognize the revenue the moment I've completed the work and I deliver to that organization the written audit report. So, identifying the expenses. Again, the expense recognition principles. Okay, first of all, what have you used during the period? It says incurred, and I like that word, but I like to use used because it really does hit home with students. If you've used something, you've incurred something. You've incurred an expense. And you want to measure that. Again, you want to match that period or that expense, that use of that whatever you did use. You want to match it in the same period that the revenue that is earning. That is the matching principle. You're matching your expenses with the revenue it generates, and in the same period. You want to do it in the same period. So we're matching revenues and expenses, matching them together. I have incurred some expenses, and these expenses allow me to earn this revenue, and we're going to put them together or record them in the same period to match those revenues with the expenses that we've incurred during that period. So again, we are talking about recognizing revenues in the period that it is earned. We want to recognize, or we want to record expenses when we have used them in the same period. We want to match them together, which is the basic fundamentals of accrual accounting. It's using the revenue recognition rule, and it is using the matching principle, which in this case, the expense recognition principle, matching those expenses with the revenues that they've earned, that was earned in the proper period. That's essentially the procedure. And it's going to guide you in every way, because it's going to tell you when to record things, when to record it, how to record it, and in some instances, the dollar amount. So adjusting the accounts. Again, we have created all these transactions during the period, and we recorded them and we transferred those transactions to the ledger accounts. And these ledger accounts are called cash and accounts receivable, accounts payable, etc. Once we have gotten all the transactions for all the ledgers, we're going to foot those transactions and come up with a total. Those total per ledger, we're going to use that information to create this. And this is called an unadjusted trial balance. And it is a listing of accounts and their balances as a specific period in debit credit format. But notice also, this is very important, it's not just creating this trial balance, which is a listing of accounts and their balances in debit credit format, but look at the order in which these transactions or these counts appear. You'll notice that the assets are listed, and the liquid assets are listed first, and the long-lived assets are listed last. Here we have the current liabilities listed first, and the long-term liabilities. Then we're also showing the equity. And here is equity, and then we have revenues and expenses. This is kind of important, ladies and gentlemen, because you're going to find out that there is a method to our accounting madness. And one of the rules that I like to show students is to say, there's a reason why we do what we do and why things are presented in the manner in which they're presented. It really does help you understand once you see these little nitpicky types of things. But the purpose of a trial balance is really to allow you the opportunity to create your adjusting entries and then make and facilitate, in this case, any type of adjustments that certain accounts will require in order to have accurate ending balance for your financial statements. So when we're adjusting our accounts, we have to account for deferrals. We have to account for an allocation of expenses over time, over assets useful life, which is again depreciation. And we have to record our accruals. And again, accruals are expenses that we've incurred, but we have not recorded them. That's important. So we're going to make certain that our deferrals are going to be something that we receive cash in advance of actually earning the revenues. So that means we got to defer recording the revenue to a later period, but we still have to show that we have some obligation to perform that service or that product that we have to give to a client. Depreciation, mostly for long-lived assets. In this case, we call it plant assets. We want to say that this asset not only will be used in this year, but we're going to be using it for the next 5 years. So that means we got to take that cost of that asset and spread its use over the period that we're going to use that asset, and it's called the useful life. So adjusting the accounts. Prepaid expenses are a very, very good example of an item that is a deferral. We pay for insurance expense, but we pay 12 months of it. So we are basically paying it in advance of we're being able to make use of that insurance. We need to record an asset because we have a future benefit. Therefore, prepaid expenses of any kind will be an asset because it provides a future benefit to that company. So, prepaid expenses. So, for example, we spend $3,000 to a landlord, but we pay for our rent in 3 months in advance. We have not used the rent, meaning we have not incurred the rent obligation because guess what? We paid it in advance. So on June 1st, we have to show that we have an asset, prepaid rent of $3,000. 3 months of rent, $1,000 each month. And we did that with cash. So what happens then? Every single month thereafter, for the next 3 months, we're going to have to show what we have incurred. And the next entry, June 30th, we're going to show 1/3 of the rent we have used or incurred. And the expense is going to be debited, and we're going to reduce our prepaid rent asset. And you can see with this transaction in the T account below, you'll see $3,000 is what we had initially recorded. Now we have a $1,000 credit adjustment. So we have a net overall debit balance in our account. Notice how we're this particular account is an asset. And also notice how when we are going to decrease this asset, we have to credit it, as you see here in June 30th. And if we see debits and credits in one account, we are going to net the two together to give us an overall net balance. In this case, a net debit balance for our prepaid. And this is something very important to notice, because when you're doing your T accounts with your homework and also with a project, you're going to see how are we going to know how to get the true ending balance of an account. We're going to net our debits, and we're going to net our credits, and we're going to net them together to come with an overall net balance, either a debit side or a credit side. So that's very important. So here we are paid cash of $700 for cleaning supplies. Now remember, here cleaning supplies is an asset. It is not an expense. We have not used it yet. This is an asset for us to use in the future for more cleaning and that sort of thing. So we are going to debit our asset called supplies for $700, and we're going to credit our cash. Now, here we are again dealing with these issues here. We have to make certain that we know how to deal with transactions and how to analyze them so that we can record them correctly. Now let's assume here that on this entry here, June 2nd, we purchased the supplies. Now, if we go to the end of the month and we notice that at the end of the month, we only have $400 of supplies left, what does that tell you? That tells you that we've used the difference between what we purchased and what we have on hand. We actually used $300 worth of supplies. So now we can record our expense because we have used or incurred the expense. We have used our asset called supplies. We haven't used all of our supplies, but we have used some of the supplies. And notice how on the T account below, how the supplies account asset has gone down because we've credited. So assets are decreased with credits and increased with debits. Depreciation is another thing. And again, we have to adjust our accounts. We have to show the use of our long-lived assets, buildings, furniture, and equipment. So we have to depreciate. We have to allocate that cost over its useful life. And there are many different ways in order to record the depreciation expense. The main point we're making in this particular example is we want to be able to show how much of that asset we have used, how much we have incurred, and we want to match that cost to the appropriate period. So we use depreciation to do that. So we want to show our costs being spread over its useful life, and we want to make certain that assets that decline in usefulness are allocated or depreciated. Land does not depreciate because land has a finite lifespan, and its usefulness will not be declined unless we have some kind of natural disaster. Now, if you can see, I'm going through these transactions one by one. These transactions, as you may know, are not necessarily overly complicated, but it does give you an opportunity to just get an idea of how to look at transactions when you see them in front of you, how to look at them, and how to properly analyze them so that you can accurately record them on your books. So here we are. We're going to purchase equipment, and we're going to purchase the equipment on account. Equipment is going to be our asset. We know assets go up with debits. And as you can see on the T account below, a debit is going to be on the left-hand side. That's going to be a debit. So here we are. Equipment's being debited for $24,000. On account tells you that we didn't pay it in cash. So we have to assume on accounts payable or note payable or something like that. So we're going to increase our asset of $24,000 for equipment, and we're going to increase our liability, called accounts payable, for $24,000. We now have a clear debits equals credits, a balanced entry. Now that we have this information on this asset, we are going to speed through to the end of the period, and we're going to record the depreciation. Now for us, we're going to just use a very simple straight line method. So we're going to take our costs, we're going to subtract any salvage value, if there is any, and we're going to divide it over its useful life. Well, we don't have a salvage value for this asset, it appears. So if we take our cost of $24,000 and we divide it by 5 years, we get $4,800 annually, or 12 months. Well, we have to find out what the monthly depreciation is. And all we need to do is divide it by 12 months. So we know $400 per month is going to be the monthly depreciation for this asset. So for the month of June, we're going to record depreciation expense. And that's the use of our long-lived asset. And we're going to charge accumulated depreciation. And here is an example of what it looks like in terms of a T account. So the accumulated depreciation account, this account allows us to be able to show on our balance sheet the net realizable value of our asset. So what we want to show then is, here is this contra account, and a contra account is going to always offset something. So if we're offsetting an asset, in this case, the contra account is going to have a credit balance. So we're all offsetting this asset called equipment. So our equipment is, we purchase it for X amount of thousands of dollars, and then we're going to show in our accumulated depreciation how much we've used over the life of that asset, in this case 5 years or so. And we're going to take those two numbers and we're going to net them, because we're going to get the net book value of that asset. At any time on our balance sheet, we're going to always show what that asset is worth to us. And it is most certainly in a companion account. So when you look at a balance sheet, you can always see that. And here's a very good example of how the equipment look in our example and the accumulated depreciation. So this $23,600 is the book value of our equipment. Then we add to that the asset that's called land. So if we add the $18,000 and the $23,600, our book value of our assets is $41,600. Accrued expenses. Again, these are liabilities that have arisen, or some obligations to pay that we haven't recorded, nor have we paid it. That's very, very important. They are not recorded and they are not paid. That's the only time you will record accrued expenses. They must be obligations that we must pay at some point that we have not paid, and they must not be recorded on the books. And that's important. Both of those two criteria have to be met in order to record an accrued expense. And here's an example of accrued expense. Aladdin Travel pays its employees monthly of $1,800, half on the 15th and half on the last day of the month. The following calendar in June shows the pay dates circled. Assume that the payday falls on a Sunday. Aladdin pays the employees the following Monday. Now, in real world, for most companies, if your payday falls on a Sunday, they're going to pay you on a Friday. But for the sake of this example, we're just going to say that instead of them being paid on a Friday, they're going to be paid on a Monday, which is the day after, which is an absolute no-no, by the way. But we're going to just assume for the example they're going to pay the next month. Now, how do we deal with this? Well, let's see. As of June 15th, we're going to show, okay, again, salary expense and cash. We're paying our employees. But when we get to the end of the month, we have not paid the employees yet. We're not going to pay them until July 1. So what happens then is we have to show that they have completed the work for us. Therefore, we have used their services, their labor. We've incurred the expense. We have to show that. But we haven't paid them yet. So what do? We have to show there's an obligation to pay them. And that's this salary payable. And look at the below T accounts. And you can see we're debiting the expense of $900 in here for the accrual. And we're showing a corresponding credit to salaries payable. And salaries payable is a short-term liability. Very important. This is a short-term liability because guess what? We're going to pay that obligation within 1 year. Obligations that are paid within 1 year are considered short-term liabilities. So accrued revenues are just that. If you have earned it and have not been, if you have earned it and have not been paid, if you have earned it and you have not recorded that revenue, you have to accrue it. And it has to be both. You have to be able to say, I have earned the money and I have not recorded the transaction on my books. And if I have not, I now have to accrue for it. So let's assume that in June, the hotel agrees to pay Aladdin a commission on $600 for booking 100 clients to his hotel over the next 30 days. Aladdin books 50 clients in June and 50 in July. Aladdin will earn half its month's fee, $300 for work done from June 15th to June 30th. And note, we have not recorded this transaction. And note also, the client has not paid us. But it doesn't matter. Whether the client has paid you is not the point. When you're talking accrual-based accounting, it's whether you've earned it or not. And we need a recording in the period that it has been earned. So we're making certain of that. So again, in June 30th, we have to show we have a receivable. We are going to expect an asset at some point in the future. This organization is going to expect an asset called accounts receivable. Their client is going to pay them their commissions. And that commission is going to be the $300, one half of what they have earned. and then the service revenue of $300. And you can see again the transaction in T account form. It's two ways to present or to visualize what is actually happening on these transactions. And what I want to emphasize again with all of these transactions is that it allows you to be able to break down a particular transaction and understand exactly what's happening, what exactly is going on. In this case, we have to show, well, we have to recognize the revenue that we have earned. That's what we're doing here in this transaction. And if we're recognizing the revenue that we have earned and not been paid, we are showing an expectation of a receivable. That's very important. So when you're analyzing transactions, you really need to understand what has occurred. And has an asset been, there's an asset in this transaction? Is there a revenue? Have we earned money? Have we incurred an expense? That sort of thing. So when you're going through these transactions and you're reviewing them, think about what exactly is going on with the transaction. It will very much be helpful when you're trying to record it. Now, we receive cash from a client, but we haven't done the work yet, or we haven't completed the work yet. That is considered an unearned revenue. And that unearned revenue, meaning you receive the money before you've actually done the work or before you've earned it, that creates an obligation. An obligation is the equivalent of a liability. So Disney engages Aladdin and pays them commissions in advance to book clients to their resort. Assume Disney pays Aladdin $400 monthly, beginning immediately. So he collects the first amount on June 15th. Has Aladdin earned the money? No, but Aladdin has received cash. So we have to show the cash that was received. But we also have to show that there is an obligation for Aladdin to perform a service. In this case, unearned service revenue. So they have to perform the work. So they can't show revenue in this case because they haven't earned it. But they do have to show an obligation. They have an obligation to perform. So we're going to increase our cash, and we're going to increase, in this case with a credit, the revenue for services to be rendered to Disney. And now, during the last few days of the month, Aladdin books clients into Disney World Resort and earned 1/2 of the $400. So we have to remove part of the obligation because we've only done some of the work, and we have to recognize the revenue that has been earned, only a portion that we have earned. Again, we want to show what we have earned only, and the rest will remain an obligation to provide that service. And this is just giving you a visual depiction of how these transactions look when recording prepaids and unearned. Again, it's just when we receive cash for services that we have not rendered, we have to show an obligation. If we pay cash for a service that we have not received, we have to show a benefit in the future, which is a prepaid. So now, the adjustment process. Again, we know the general types of adjusting entries that will need to be recorded in the different categories. Now, let's talk about what we are doing, why we are doing it. The purpose of adjusting is going to be to measure income and also to update the balance sheet. Again, the balance sheet really is about the residual. It's going to be the assets equal to liabilities plus equity. So we got to make certain that our balance sheet accounts are accurate. We have to be certain that if we've used assets, we need to show that we've used those assets and show that net realizable value or their book value correctly. We also have to show the measurement of our revenues and expenses. If there are some revenues that we haven't recorded, we need to record those. If there are some expenses that we have incurred, we need to record those as well. So we need to make certain our balance sheet and our income statement reflects the activities for the period. And here is a very good idea of in summary how adjusting entries work. Generally speaking, you're not going to see adjusting entries affecting cash. That's very, very important in general. Unless there's a mistake or an error being made, your adjusting entries are going to be really non-cash. So prepaid expenses, we're going to show our expense and we're going to reduce our asset. Depreciation, again, we're going to show our expense and we're going to show a increase in our contra, in this case, accumulated depreciation. And our accrued expenses, we're most certainly going to be showing an expense, and we're going to also show the incurrence of an obligation. In this case, we were talking about salaries and wages. Our revenues, we're going to show, again, an expectation of revenue or cash received, which is an accounts receivable, and the recognition of revenue earned. And in the case of non-unearned revenues, we're going to show an obligation. We're going to show whether or not we've earned the revenue. We're going to show that obligation, that we no longer have an obligation there, and we're going to show the revenue that we've earned during that period of time. So it's important. These are the very general entries that you're going to be making when you're adjusting the books. Again, all of your entries for the month or the period has been made. Now you have to adjust the accounts to make sure that they're accurate. So income tax accrual. Again, this is just saying that we have shown on our books all of our expenses and our revenues for the period. Now we have to kind of guess as to the income tax expense that we have to pay at some point. And here we're going to show, based on our tax rate, we're going to say, oh, we have $600 worth of taxes that we're going to have to pay at some point. This is just entry just to show our expense and then our obligation to pay our taxes or our income taxes. And here are a very good summary of the types of transactions that you are normally adjusted, and the type of and the debit and credit that will be needed to adjust them. This is an excellent exhibit because you can print this out and it can really be helpful when you're doing adjusting entries. A lot of times these entries are going to be exactly the same. The only difference truly could very well be the dollar amount. But the main thing is to use this as a guide and to help you when you're recording your transactions and make certain that you're on the right track and you didn't make a mistake. These are very, very good tools to use. And here is the same information, but we're showing it in T account format. Very important to see how when we record these transactions, what the impact it has on the various accounts. It gives you a very good visual when you see the supplies being recorded at $700 and then we adjust it to $300, and then it gives you an ending balance of $400. And each one of these accounts, all of the numbers are going to transfer over to our trial balance, but we're only going to show the ending balance. So in cash and accounts payable, all we're going to see are the ending balance of $36,800 and the $13,100. We're not going to see the details. So here we have an adjusted trial balance. Remember, back in the beginning of this lecture, we showed the trial balance unadjusted. Now we're going to show all the transactions that we recorded in our examples, the debits and the credits, and how they affect various accounts. And you will notice how cash was never touched. I would say with this course, you will not see any adjustments in the cash accounts, but you will see other accounts being adjusted. And here is a good depiction. And when we look at the adjusted trial balance, these are the accounts that we're going to use, F and G, when we create our financial statements. So let's construct our financial statements. Now I'm going to go back a second and just take a look at it. If you look at how we presented this trial balance, you'll see the assets and liabilities and equity, right? And then we're going to see our revenues and our expenses. It's clear to me that here is our balance sheet from column or from row 4 all the way down to row 17. But then you're going to see also our income statement is going to be our row 18 all the way down to row 25. And then our statement of retained earnings, we're going to be using row 15 all the way to row 17. So here we are. Let's take a look at the financial statements. Here, in this example, when you're preparing the financial statements, it is important that you prepare the income statement first. That's going to be the first one you do. And here the income statement shows our revenue. In this case, simple as it may seem, we only have one revenue line item, but we have several expenses here. And we take our revenues and we subtract the sum total of all of our expenses to come up to our net income, or our income before income tax. And then we have our one income tax entry, and then we have net income. We're going to use that $2,900, and we're going to use that to say, okay, if our retained earnings at the beginning of the period is $18,800, we're going to add our net income to come up with our subtotal. And any dividends that we've declared, we're going to subtract that to come down to our ending retained earnings. This $18,500 then will be used to create the remaining portion of our equity section, which is our retained earnings. And then here in our balance sheet, which is the last statement that you will be creating when you do your balance sheet or you're doing your entire financial statements, is our assets, starting from liquid assets to our long-lived assets. our liabilities from our current assets to our long-term, which we don't have any in this case, as liabilities. And then we have our equity, starting with common stock, retained earnings. And then we have our liabilities and equity added together, which is the 68.5 added to the 14,800 to come up to our 83.3. And one of the things you can see is these two numbers agree. Assets are equal to the sum total of our liabilities and our equity. So now we need to close our books. Again, temporary accounts. These are accounts that have only one period worth of transactions, and that's going to be our revenues, expenses, and our dividends. Permanent accounts, which have many years of data, are not closed, and they are our asset accounts, our liabilities, and our equity. So we want to clear or zero out our revenues, and we want to clear or zero out our debit balances and our expenses, and we want to clear or zero out our dividends. And here's an example how to do that. Again, revenues will have a credit balance. So to remove the credit balance, we have to debit it, as we see here. And the same thing is happening here. When we are dealing with our expenses, we're going to clear or zero out our expenses. And expenses are normally debited. So to clear them out, we have to credit them. And everything is being closed to retained earnings. And as you can see here, retained earnings, the net change is going to be the difference between the 7,500 and the 4,600. And any dividends that was declared, we're going to clear that and move that from being a debit balance, because dividends are debited, and we're going to take that and offset it with retained earnings. And here is another way to visualize the posting of these entries. Again, rent expense, we closed it with the credit. All the expenses, as you can see, are being closed with credits. And then here are our revenues. Let's see if I can find our revenues. Here are our revenues here, and we're going to close it with a debit. And everything is being closed. Here's our expenses, and then our debits, and then here's our revenues being closed. And here dividends is being closed because we recorded a debit balance or a debit entry, but to close it we have to credit it. So we are zeroing out our temporary accounts. And once we do that, we can then at one prepare our post-closing trial balance, which I think we're going to talk about all of that. Again, current assets are going to be the liquid ones, and I've been talking about that from day one. Assets that have a lifespan of 1 year or less are going to be called short-term. Liquid assets are going to be shown first, and we can give you an example of these very liquid assets. Liquid meaning cash. When they convert to cash quickly, they're going to be the liquid assets. And assets that we have to sell, again, not current, or assets that we have to take years to pay or to use them up, long-lived assets like plant, property, and equipment. These are going to be shown later or below the current assets. And the same is true with liabilities. These liabilities have a maturity date of a year or less. They're going to be current. And examples include AP, notes payable due within 1 year, salary payable, income tax payable are just some of the examples. Long-term assets, 1 year or longer. Note payables are an example. Bonds payable are another example of long-term liabilities that will be paid after 1 year. And here is an example of a classified consolidated balance sheet, and it shows again the assets in categories like current and non-current, and we're showing it in comparative basis because we're showing 2 years side by side, and we've talked about this in chapters 1 and 2. So the financial statements, again, we're going to talk about the financial statement structure, again, balance sheet, income statement, again, report and account, single step, multi-step. A main thing is, I believe, is what are the purposes of these statements. That's really important. What's the purpose of a balance sheet? It's going to be the financial position. What is the financial position? What is the residual leftover assets that the ownerships have used or can use to grow the business? The income statement is profitability over a period of time, and the retained earnings is going to be the changes in retained earnings over a period of time. So that's really what they are, what their purposes are of these statements, and why they're important and why they're useful. And finally, how do we determine an organization's ability to pay their bills? And it's going to be what's their net working capital and what is their debt ratio. The net working capital is going to be the difference between your current assets and your current liabilities, and it really is important for liquidity. how well this organization uses their assets to pay their bills. How well are they leveraged to meet obligations as they become due? And you can use that ratio, the current ratio, again, and it's really representing their liquidity. A high ratio really means that the organization does have the cash to pay their bills, and they are solvent, and you can rely on them to pay back what they owe. A debt ratio is really the measure of their ability to pay their debt, and it's measured based on the total liabilities versus total assets. And a lower number is definitely a better ratio than a high. And again, using an organization or industry standards to compare it is also a good way to measure the debt ratio and how well that organization is paying its bills in relative to the industry. Are they better off? Are they the same? Are they worse off? That type of thing. So again, I'm going to stop with this particular transaction and just say, when we're looking at financial statements, it's important to note what these statements mean and how they're used, but it's also important for us to be able to dig a little deeper. How do we answer certain questions? What kind of information we can provide users of that information? And again, ratios do help with that, with those kind of questions. Can they pay their bills when they become due? How solvent are they? How are they making use of their debt? Are they is their debt consistent with the industry? Are they better off in the industry? Are they better off? Or are they worse off? And those kind of questions. And again, you're analyzing the relationship of their financial statements with what's going on in the industry. And using ratios allows you to compare companies to companies regardless of their size. Ratios are very, very useful in that. Again, I thank you very much for your time, and I'm hopeful that this lecture provided useful information that will help you with your assignments. And I will talk to you again in the next chapter. Thank you.